Hey everyone, I'm excited today. I'm here with my friend Chris Rowe from, he's the founder and CEO of True Market Insiders. It's not his first finpub, but it's been a really great finpub over the last several years. He's grown it quite aggressively, very successfully. He and Dylan Jovine had actually exited another finpub prior to that. Chris has an enormous amount of experience both in trader education, financial publishing, financial markets. Thanks for being here, Chris. I'm excited to kind of get your views today.
Thanks for having me, John.
You actually just before this call, you kind of, we were talking about how we could kind of start off, and you really went down an interesting road here where you said, you'd love to kind of take this back, like talking about the retail investor, talking about the trading environment, talking about the market environment from a publishing standpoint. You said going back into the 70s. You want to let's go like back into history and talk a little bit about like this environment of investing and trading and how it's evolved up to where we're at now.
Sure. Yeah, and the evolution of it since 74, Charles Schwab and the deregulation of commissions and things like that, it goes through a number of different cycles. And every time you go through one of these cycles, you go through a bear market and a washout period where everybody kind of looks at what happened in the past and they look for the new way of doing things. So it kind of fits into what you're talking about with the evolution of financial publishing. And a lot of times I use the brokerage industry as an example because to draw a parallel, because I kind of see financial publishing kind of going the way of the broker, where the broker in the 1990s kind of went through their evolution. And they continued on for a long time after that. I don't think that financial publishing will go away. Stockbrokers didn't necessarily go away, but they tapered off and it kind of became a new thing. So starting with the evolution of the industry, if we start with Charles Schwab, when commissions were deregulated in 1974, people found a way to execute trades on their own, discount brokers, so you can compete in commissions. So now you have people that decide, all right, remember 1974 was a bear market bottom. So it was after one of these cycles, it's a new way of doing things now. It's like, now I can execute my own trades. So then they do that. Leading into 1987, there was a big bull market. It was a very strong year. Most people don't know this. 1987 was actually a positive year. It was a huge upside and then a big decline. But traders wouldn't answer their phones, so people couldn't sell their stocks. If you watch the Madoff documentary or whatever the Madoff Netflix thing is, they dive into that, where traders weren't answering their phones. So coming out of that, they created SOS, the small order execution system, where traders could send trades directly down to the floor and they don't have to bypass people like Madoff, let's just say. Okay, so then they fixed that problem. But still, people were stung. After you go through in 1987, for years after that, you're kind of like scared to get in the market. Just like in 2008, people didn't really get into the market. Retail didn't really get into the market until 2013, 2012. So coming out of that, you go into the 90s, and then you had people pretty much shying away from the market. They went through the S&L crisis. They said, this is for the elite. This is not for me. The retail investors, mutual funds. I don't know anything about the market. And what's interesting is with each of these cycles, it's just the individual retail self-directed investor is always kind of smacked around, taught a lesson, saying this is not for you. You're not supposed to be doing this. Just go back to mutual funds. Then in the 90s, you had the boiler rooms, right? Then you started out with, I think Salomon Brothers and Lehman Brothers were calling, the Midwest, saying they're calling from their Wall Street address with their New York accent. And then today must be my lucky day. And that worked for a while, but it became such easy money that bad players got into it. Anytime there's big money in something, bad players are going to be attracted. And then first boiler rooms started getting shut down. And at the same time, remember, online brokerage became a thing. It was the 90s. Everybody was making money. Your next door neighbor was getting rich, changing houses, buying a couple vacation homes. It's the same old story. And they got to take control of their own money. So they were sick and tired of getting churned. They were sick and tired of wondering if they're investing in a real company from these boiler rooms. They go online right at the market top, like as the market's topping out. And then, I worked on Wall Street during that time. Every week you would see a string of guys in suits being let out by whoever, the authorities, kind of handcuffed to one another in a string into a paddy wagon. So these firms were getting shut down left and right everywhere you go. And at the same time, people moved online to control their own investments. They thought that anybody could do it because everything was supposedly going higher, which it wasn't. As of April 98, most things were going lower, but they saw the averages going higher, so they stayed in. They got smashed in the tech meltdown, whatever you want to call it, the bear market that lasted about 2.5 years. Another washout period. So that's when people became familiar and comfortable with the internet. And it took another 10 years for them to get really comfortable with the internet. So first they would seek out newsletters, subscription services, trading services, things like that, which is the new stockbroker. And keep in mind, not only were the boiler rooms attacked, but Elliot Spitzer, the New York State Attorney General at the time, went after the top 10 biggest banks and brokers, which were the same thing at the time. They settled out. He charged them with fraud, and they settled out for $1.4 billion, the biggest names in the world. So now it's not only the boiler rooms, it's also the biggest names you thought you could trust. Biggest level of distrust since, who knows, 74, the Great Depression. So now you have the internet, people become more familiar, more comfortable. It's not even so much that they trust the internet. They're just like, fuck that. I'm not going to deal with these boiler room brokers or the wirehouses. Nobody has my interests at heart, which coming out of any bear market, that's how everybody feels. Yeah, Tyco, WorldCom, Enron, that's when all the scams kind of surface. Then you have, that's when I got into financial publishing. I left Wall Street, 2004, I got into financial publishing. Trading services were the first thing. It wasn't so much that they loved this, it's just that they hated that. So they kind of fled to this. And then it became, users became more trusting of the internet, and there was a lot more legitimacy. So they started trusting investing education. They said, I could do this. And again, you're coming out of a bear market low, so it's just constant upside for the stock market. Again, I can do this. This is my day. Investing education, that worked out. We did really well, becoming an investing education firm. We never let go of the trading service side of it. We kind of wanted to. We tried to evolve into an investing education firm solely. And then we started getting into data. So tools, data, indicators, and things like that. Then we got acquired by Agora. It's important to understand it during that time. So when we launched, it was called Tycoon Publishing. It's Dylan Jovine and me. We recruited, Teeka Tiwari, we used to work with on Wall Street. A lot of names that in the industry right now came to work with us. And we kind of had an investing approach that is timeless. It's adaptive in any market environment. It's what we really used on Wall Street. And so we built the audience using the financial publishing model. It's not necessarily a model that we felt very comfortable with, but it was the only model to reach as many retail investors as we possibly could. So we learned that model, and we brought our investing approach to it. And it's kind of, we'll teach it to you, we'll arm you with the tools to do it yourself, or we'll just do it for you, or all of the above. And the way I see it now, I think that, there's never really been a time, I don't think it's ever been really possible to give the subscriber the experience that's going to really and truly benefit them, make them a much stronger investor. Maybe in bits and pieces, there's lots of pieces to the puzzle out there. There's different approaches that they teach, but people have to learn a little bit at a time and kind of put it together themselves. And now I think for the first time ever, because of where we are in terms of technology and AI and people's confidence level and things like that, I think for the first time ever, we now have the ability to provide an experience that actually makes people become better investors and have an investment approach that they can customize for themselves.
All right, I want to stop you there because I'm going to go back because two things I want to cover. One is I love the way that you kind of frame the meta environment of it's kind of like this macro trend that's been happening on a think of like a consumer trend that's been happening since the 70s, which is this movement towards the traders and investors, retail investors, but not just retail investors, constantly trying to get more transparent information, get better information, get better access to markets. And then you also have like something that you said that I think would probably give a few people conniptions, the way that you phrased it. And so I want to kind of tease it out. And you said that newsletters are kind of the new brokers. And I totally get what you're saying. And basically, I think if I'm understanding this correctly, what you're saying was that the way that investors were getting information used to be stockbrokers. It used to be through those boiler rooms at one point. Those became distribution sources for
Or
information.
legitimate brokerage firms and
Right.
legitimate brokerage firms.
Right. Well, I mean, even the early boiler rooms were relatively legitimate. It was a phone model. It was basically a marketing model takes over on Wall Street, and that marketing model is going to be used effectively, ethically, and the more successful it is, the more gray and the more unethical players start to get attracted to it, because
Right.
by the nature of it, there's more money involved. And so while newsletter publishing doesn't have a brokerage model, it doesn't have a commission model, it doesn't have any of those models from a customer standpoint, it is a research house. It's an information source, and it has become a channel for distributing information to investors at scale. Right, that's kind of what you're saying when you make that comparison.
I mean, when I was talking about that, I was speaking about it through the context of the customer. So the customer is trying to find a way to become a better investor, find a way to not have to trust somebody else to do it, because they know that they're going to take better care of themselves than anybody else. So I was kind of speaking about it from the perspective of a customer who, reaches the hand in and ultimately gets burned, and then another cycle happens, and then they reach their hand and they get burned. And I think now we're at a place where they don't necessarily have to go through that. I think anytime there's a lot of money being made in anything, you're going to have bad players that come. Now, if you're looking at it from my perspective as opposed to the customer's perspective, or any players out there that are really trying to provide a high quality service, you're looking at the evolution of the industry too from the other side. And so, for example, when online brokerage came out and people started fleeing to online brokerage, and then people in the brokerage industry are saying, well, what are we going to do? That now they're giving away trades for free. And if you're if commission's the only thing you're concerned about, I mean, you're going to fail. But if you're thinking about the service, what we would do then is we created an online brokerage firm. I wasn't the creator of it. I was like employee number 3 or 4, but IPOsyndicate.com. What we did is we created an online brokerage platform. We also gave IPOs. We were probably the first company to give individual investors real IPOs. And we were a full service brokerage firm. So from the provider perspective, we would adapt to the changes in the industry. And so if I'm saying that it's similar to the brokerage industry, what I'm saying is that the brokerage industry was kind of squeezed in terms of their profit margins. They were squeezed in terms of the bid-ask spread got really tight. They were squeezed in terms of the do not call list, where they can no longer cold call. They're squeezed in a lot of different ways. And then the online brokerage came. And that's the parallel that I'm drawing to financial publishing, where you have the FTC, less hyperbolic copy. You have people that are viewing their inbox kind of as gen pop, right? That's like, if you don't know me, you're going to contact me through my email inbox. It's like borderline LinkedIn, as opposed to a niche place on a platform. If I'm messaging you because you came here because you're interested in this, now I'm messaging you there. So there's all these different things that are happening that are squeezing profit margins in financial publishing space. That's kind of forcing it to evolve, but I think it's forcing it to evolve in a good way. And I'll end this part on this, is that I think you're doing an amazing thing. I just want to put that out there for the industry. If not for you and your team and everything that you do, the industry would be trying to kind of feel its way around. We of course have the annual publishers roundtable, and that's helpful. But you are really raising the bar, causing people, to really step up. And at a time when the industry needs a North Star most, you're here to provide that.
Thanks.
So I think you're doing good things for the world, like, let alone the industry. It's great for the industry. I think that this industry has so much potential to help the world, and to actually help self-directed investors. And like, we can actually do it. It's kind of confusing. It's tough. There's never really been the dynamic and the technology to bring it the way that there is now. And I think now that we have people as confident with the internet and as confident in indicators and data, they have confidence in themselves and their ability to do things and the technology to do it. I think it's a damn good thing that you're here to kind of guide that evolution. I think we're going to provide something great. I think you're going to be a big reason that the world changes for the better, because of the players that do it the right way.
I appreciate that, man. That's like the nicest thing anyone's ever said to me, I think. Thank you. Um,
I'm a great salesman.
no, but well, I think that's like whenever we get into the world of marketing and finance, like it's almost like, from a general population standpoint, like, okay, these are like the two worst peoples in the world. Like there's this great old like saying my father-in-law says, and it's like, that's cold, it's colder than a banker's heart, right? um and then marketers are basically seen as scumbags. And so like there's all this room for I don't want to say bad behavior, but it's you could say it's unethical, but it's also just like it's very easy in a direct response model to convince people to sell people into things. And if you are purely looking at a direct response um through a direct response lens and not through a product lens, not through a customer lens, you can always find things that you can say to get higher conversions, higher response. And if you go down that road long enough, it always ends unrestricted, in a place where you said things that just aren't true. And
Yeah.
it's not just finance, it's every industry. It's just the nature of like um uh a copy focus, right? Like, and so
Mhm.
having an understanding, I think, of who the customer is, what the customer's trying to do, and actually like, I mentioned this in a previous conversation I had. Like, I feel like there's been this kind of war between the approach of I'm talking to investors about investing things and I'm infotainment in the industry. And
Mhm.
when the bull market was exploding, the infotainment side, and that is not an illegitimate aspect of the online environment. Like a lot of it is entertainment and even things that you're interested in. Um, but that copy on the infotainment side gets more and more aggressive, gets more and more hyperbolic, gets more and more kind of like
Yeah.
out there versus and it becomes copy first, not idea first, like investment
Yeah.
idea first. And so then the product follows the marketing because it follows what
That's what they said.
converts, right?
Yeah.
Versus like a much harder business sometimes, which is we have this investment approach, we have these investing ideas, we believe that these are the best, and we are going to try and position these for people in a way that they are excited about them, even if they aren't when you just tell them right away, right?
Yeah.
um and so
So,
like that's
go
that's a dynamic that is inherent, I think, in like it's in the nature of any aspect of finance, because it's true in sales too. Like the sales guy at an investment bank, if he's not constrained by the quality of company or constrained by other factors, like you're going to have a certain segment of the sales floor that's just going to say whatever the hell they can
ahead.
to get the money. And so just this inherent tension in financial markets, around like a sales copy approach and a product approach. um, and I think that's where like what you guys are doing is so interesting, and there's some really great product focused and customer focused um, entrepreneurs in our space. And I think of you as one of them because you do like it's I think of it as like I can tell in the back of the room at the events when I'm talking to people or on the phone calls. There are some people who, when you talk to them, they always mention or frame things around what's good for the customer, what's good for the investor. It's always kind of being related back to them. And then you have other people who are fantastic marketers who literally that phrase, that concept, that never comes out of their mouth. They never really connected back to what's good for the customer. It's all about just the promo idea. And that's where like I think like that's the risky, like you get hyperbolic and start pushing. Um and there's the not to keep rambling on this, but when things are good, sometimes those folks are having bigger successes in like the super bullish phases,
Mhm.
explosive phases of the market, because people are just buying whatever, and the more you promise them. But then those also are the ones that the FTC, um not always, not everybody who's in that camp or who got an FTC case was in that camp. but it's that type of marketing that kind of gets people to look at our industry from a negative standpoint, I think.
Yeah, and people don't learn the lessons of history. But I mean, it's human nature, right? I mean, when something's really working well, and whether it's crypto or the bull market, and everybody's making money, it's like everybody parties. It's like a party. People get drunk. They start doing one little thing that's a little irresponsible, and before you know it, everybody's passed out on the floor the next day, wondering what the hell happened.
Right.
And it's just a cycle. It's human nature. And the thing that makes this so interesting to me is that the industry, it has to change now. It's very scary to change what works. And it's not only just making one decision. It's not one guy making one decision. It's 1,000 people, copywriters included, that have trained themselves to write a certain way to a certain person. Right now it's a niche industry that's evolving into something that's probably more of a mainstream industry by force, partially because of FTC stuff and so forth. And then so you have to evolve all these people. I'm managing one company. We're a small company. It's hard, to get a whole bunch of people to follow the same North Star, see the same thing. People come from all these different firms, have been trained a certain way, and they know what's worked for them in the past. So it's very hard to it's scary, the idea of changing to something that is not going to convert as well. And ultimately you have to think about the pay structures for copywriters and things like that, because now it's kind of a different ballgame. You're going for the longer term relationship. You're delivering something that works really well, and it's not so much of an impulse buy. If you're moving from financial publishing, which is, again, it's a niche product and a niche audience, to something that's a little bit more mainstream, you've got the metrics, the LTV, the lifetime value changes. You get it maybe a little bit more gradually for a longer period of time. So that's very scary when you try to tell copywriters that's the way that we have to go. And then there's the FTC. I'm hoping that they do the right thing and really try to help the world, and not just make a collar, not just get in the news for being the person who took down the whatever firm. Because there's a lot of really great things that can happen here. I think the way that we've operated, it's kind of like, what else could we do as financial publishers? You need some infotainment. You need, or the people are not going to listen. You have to think it's kind of complex, because the customer, a lot of the time, is their own worst enemy. The customer, most of the time, they're going to buy something when the story is about something that's at its high, like say tech stocks or crypto. That's when they're going to buy the most. When you talk to them about responsibility and balancing and risk management, they kind of shut off. They have to have some level of infotainment there. You have to tell the story. You have to kind of get them hooked using marketing methods that know how to push the right buttons to get people to actually act. If not, what are they going to do? They're never going to buy. So it's kind of like the way that the copy's been written, the way that the industry's kind of grown based on strong marketing. It's kind of like, I mean, I can't blame the industry. It's like there wasn't that much that we there's not much else that we could have done up until this point. And I think we're at a point right now where that's starting to change a little bit. But it's just it seems like, I think, a big leap. It kind of changes the whole dynamic. If like, for example, I'm going after a little bit more of a mainstream audience. That's what my goal is anyway. Right now, we're working with this niche group because that's what we know, and we need to generate cash flow and stuff like that. But we're moving more towards financial technology, which is a little bit more of a service. And with a service, it's more of a pitch of, here's what you're going to get, ahead of time. Like if you sign up for Zoom, silver, gold, platinum. And where finpub is more of there's a story about the ex-CIA guy who knows his two guys in the lab with a couple of rats.
Right.
And,
because in a pure publishing model, it's very difficult to tell you what next month's editorial is going to be about, because it's about, one, it's not written yet. Two, it's about a changing market, right? So that's part of a periodical kind of a marketing problem, is that, like, I can show you what we've written about, I can talk about what's going on right now, but it's very difficult for me to tell you and promise you like 3 months from now we're going to be talking about this. And so it's really, as a product model, it's not as it's much more fluid, and that's just the nature of newsletters, and that's great. But then to your point about the infotainment piece being, I mean, there's the reality of just digital engagement. It's getting harder and harder. You have to be better and better at engagement, and regulators don't like this, I think, because it does seem more bombastic sometimes. But I mean, the reality is this has been the truth in every area of public life. Like, look at our presidential campaigns, right? I mean, they are much more, and like, it's infotainment to a degree at some point, right? Like that's why you have like some of these, like if you look at some of the more extreme seeming Congress people, right? Like that seem like they're crazy and whacked out. Pick your side. I don't care who it is, but if it's somebody who is who you perceive as being like, you know, over the top and saying crazy stuff, and you look at their donor model is usually small donors, not big donors, right? So those are the people who have to be, the more their fundraising is dependent on lots of small donors, the more kind of in your face they have to be, because that's what gets that response, and that's what engages that segment of the market. And the other part of that is that there are segments of every market that literally aren't engaged unless you have that. And so it's almost like you're not servicing that part of the market unless you're a little bit more a little bit better at being not bombastic, but like engaging. And so that's like one of those macro trends too, of just like media transforming every layer of society, and leading us into like, you have to be good at engaging people online. And there's a lot of different strategies for that. But if you're not that, then you're not in business. I mean,
yeah, I think definitely, speaking to FinPub, I think that, you know, you're nailing it every time you talk about how there's the collision course between fintech, financial media, financial services. There's traditional, and then there's next gen, or there's legacy, and then there's next gen. I think the legacy players are going to be the ones that they continue doing what they're doing. They do it really well. They do a great job. There's going to be a place for that. I think it gradually tapers over time, but not for a very long time. And one by one, you'll see people kind of dropping off. Similar, that's the parallel that I draw to the brokerage industry. You know, some people held on with both hands. Some people said, I'm going to the next thing. So yeah, but with financial media, we just acquired a company, Transformity Research, which was led by Tobin Smith. And Tobin Smith is a guy who is he's lightning in a bottle. He's big personality. He's hilarious. Everybody loves him. He's like a nice guy. And he was on Fox for like 15 years. He had a show on Fox, Bulls and Bears. And it's what we really needed, because my firm is very much technical analysis, and you'll see it in the price before you see it in the news. And that's kind of a niche. It's kind of a tough sell. But adding Tobin Smith, to me, is like a game changer, because he's somebody who can tell the story. He's infotainment. He's straight. He's hilarious. You know, he's a fun guy to watch. He's you know, Jim Cramer, but not so over the top, you know, yelling, screaming, and throwing chairs and shit. I think that is necessary for the future version of, you know, whatever it is that we're doing here, whatever the version is. I think you want to have a bigger, more mainstream audience, cast a wider net. I think we have this niche audience because people have been doing it for so long, they're not going to leave. I think that even though the copy might be hyperbolic, I think most of the people that are watching the VSLs or reading them, they know, you know, and they get past it, you know, and they weed out who's, you know, who they want to listen to and who not. And then sometimes, because they do this impulse buy, it's kind of a gamble. It's like, all right, I'm going to pay the $49. I want to see what's behind the curtain, and now I'm going to start investigating and seeing it, you know, what's what here. As opposed to a service industry, maybe the future version, next gen FinPub might involve a little bit more transparency, and therefore cast a wider net. So it's not such a niche audience. There's a lot of people out there, a lot of investors out there that would pick up a sales letter in our industry, look at it and go, you know, I wouldn't show this to my mom or my grandma, you know. But I think the future version of FinPub is less like that. I think that there's, more infotainment, a little bit more supporting technology, I think the biggest winners, or the biggest winner, is going to be the group that can give a customized experience to the user. I think that's going to be probably the biggest key, is the customized experience to the user, as opposed to just posting your ideas and then letting people, because that's one thing. This is kind of like a dopamine thing. This is like, I'm going to help you trade. This is for the person who puts $10,000 into every idea. They're not really thinking about how to balance anything. I mean, that has its own place. I think that's, there's a lot of people that want that. And there's other people that want to manage their money and want to really learn how to do it. I feel like there's three avatars. There's the dopamine person, the thrill seeker, who a lot of times is a closet thrill seeker, and they go in under the guise of wanting to manage their own money, and they end up trading a lot. You've got the person who wants to manage their money and provide, their provider for their family. They want responsibly to actually do it. They're not the closet thrill seeker. They really are the provider and don't want to trust an investment advisor. And then you've got the intellectual, or maybe even the know-it-all person, the intellectual, the person that wants to just see what we're doing, oftentimes doesn't even trade our recommendations, but they'll still pay $5,000 a year just because they want.
I think we tend, because that, I hear that a lot, and I know that, and we know that that's a persistent customer, but I think that we tend to overlook a very important nuance of the customer who buys our products and says he doesn't invest or trade personally. And that is, if you look at the massive amount of people who say they're self-directed investors, right? What they're really saying is they are mutual fund investors and they pick their own mutual funds, or they are they're doing that and they have an advisor. And I think what it is that customer base, it's not that they're just like randomly like interested in the markets and they're never going to do anything. I think that very substantial segment of our market that does that is that group that is like, they want to understand what's going on because they don't fully trust an advisor alone, right? They want to have some kind of,
it's a good point,
feeling of oversight that they can make an intelligent decision that's not based on the advisor who they know has a interest to keep their money in there, right? So I think there is that segment that like, I don't want to do it all. I want to have somebody else doing it, but I don't want to be like clueless about it. And that's why they spend the money.
There's in the demographic, there's, I guess, moving parts and evolving parts, and it evolves with the market and people's confidence level and their interest. If everybody in the barber is talking about the market, for a lot of people, I guess the majority of our customers probably have fewer than $50,000, probably don't have an investment advisor that really, cares that much to talk to them. And, it can be like a gym membership, you say, I'm going to learn how to do this. And at some point, 5 years down the road, I'm going to do it. And then, you kind of phase out of it. I have kind of a unique perspective because I manage people's money. I have an RIA, so I manage people's investment portfolios. I talk to those investors a lot of the time. So I see from their perspective, I mean, you're right. A lot of the people that have the investment advisors, all of them, almost all of them have 10% of their money that they call their play money that they trade. And then they have 100%, 90% of their money, with their advisor. And I think a lot of them want to ultimately get away from the advisor, unless it's me, of course, they want to stay with me. But those who are with other advisors probably want to ultimately get away from their advisor. And they a lot of times they'll have high hopes, and they'll subscribe and they'll, they end up where they end up. And then a lot of times they realize that they're, that it's a lot harder than they think. That's what happened in 1997, 98. People went and traded online, and they got stung, and then they realized. And then I think it came down to exactly what you're saying, is that even if they have an advisor, a broker, or even if they invest in a mutual fund and they don't have to think about it, they're passive, they still want to know what's going on. It's their money.
Right. They don't want to feel like they're completely disassociated from the markets and that things are just going to be fine, because every 10 years or so, something comes along and shows them that it's not fine.
So I have a question for you. So you have these short-term, levels of interest that go up and down with the cycles of the market and how popular it is. What do you think about the long-term cycle there? Do you think, because I think about it kind of like this. This is my own personal opinion. You look at how people viewed computers or anybody who was into networking or anything in the 80s. And there was just this very super small niche, almost borderline weirdo or somebody who's like super big brain and they're in computing and they're like, wow, that person's going to be a billionaire. And now it's just mainstream. Now it's just, people do it. Peter Lynch said, people spend more time picking out their refrigerator than they do on their investments. And I think all that has to change. And so I kind of see a world in the future where something similar to what happened to computers happens with investing, or maybe even health. There's kind of a big wave where people that didn't give a shit about their health, nobody knew anything about health, in the 80s, but now there's the Fitbits and there's the people care. There's health, wealth, family.
Oh yeah.
What do you think about the long-term picture? Do you think there's going to be kind of a overhaul in the way it happened in health or computers?
Yeah. So I think that's a fantastic point, because the way I look at it is that finance is probably the single most conservative sector in the world. And not politically, I mean, politically too, but in terms of the rate of adoption of things, like the fintech, like think about this, the fintech boom has happened in like 2017, 18, 19, right? The first tech boom was a lot earlier than that. Like this is always the case. Financial always trails other industries, but it always catches up eventually. And the fact that literally every other industry is going to exactly what you're saying, which is the customization of experience, where like it's like streaming. Like I want a platform that allows me to have the shows that I want, or a collection of platforms that lets me watch the crazy little mix of shows that I want to see. Like, and without that kind of customization and that unique experience, you're back to like, what things were 20 years ago. And the fact that it's happening in health, it's happening in entertainment, it's happening in every other aspect of or every other sector, like it's happening in finance. It just happens later. And so the idea of the mainstreaming, like I don't think it's the regulators that are mainstreaming us. It's customer demand, consumer demand is mainstreaming us. And the reason that it's mainstreaming the industry is because the way that your average American, your average European, your average just human who is in a developed society that has access to that lives in a digital, hybrid world, everything is consumed in conjunction with media in some form or another. Like other than maybe like you're buying you're not like consuming media to pick out toilet paper, but by and large, anything that is information heavy, whether it's health stuff, if you have a health problem, you are so immersed in media that's built up around that health problem, because you're trying to understand it. Because again, the doctor, you don't go to the doctor and just like anymore, if you have a problem and say, hey, like whatever you say, it's good, right? Like you're like, no, I want to understand, because how do I know
it's almost
this guy?
The last thing you do. It's almost the last thing you do. All your research, you look online,
exactly.
You get the Eastern medicine, the Western medicine, and you do as much as you can. And it's like you review the doctor himself or herself, and it's like the last thing you do.
And so with that, like you think about like it's a consumer driven trend, right? For sure. Like it's a consumer driven trend. They want to understand and know more. That's why the market is growing so much and has grown so much over the last decade. It's a change in the way that people engage with information. And then you look at that from a direct response standpoint, where we have been kind of push marketing for newsletters. And like if you have like it's just the understanding the nature of response rates, right? Like you have 1,000 prospects and you get a whatever % response. The vast majority of people who ever engage with your content, who literally engage with your content, get on your list, they do not buy your product. Like everybody's product. That's the nature, right? It's a percentage game. It's a small percentage game. A 3% response rate is a fantastic response rate, right? Like on your house, or you might get 10% of your total list to buy something. 90% never buy from you, but they're interested because they're on your list. They got on there. They were interested. They're not out of the market entirely necessarily. There's a bigger chunk of them than our product model doesn't appeal to. There's a bigger chunk of them that a different product model, like an advisor, appeals to. And so they like the information, but they don't like the product model. And so one of the trends that you're talking that you're, I know you're embracing is like the fintech, the tool model, the platform model. Like, I think there's a larger segment of the audience, of the investor audience, that is interested in that product model than they are in the newsletter product model, right? So that's why that market can be bigger.
Yeah, I think it'll take some work to get people interested in fintech and using data and things like that. Once they are bought into it, it's like putting on reading glasses. When you see the market a certain way, financial markets, you can't unsee it, and so you need this. I have data products that I've subscribed to for 25 years. Like right now, I've never let them go. Even if I didn't use them for a year, I still never let them go because it's what I need to see the market. But as far as go back to a couple of things that you said. Well, let's see. What my response to it was going to be was that the cyclical nature of our business and our customer. It's not like health. Health is always there. If it's if it's shitty economy or great economy, people are always thinking, marketers are going to have people thinking more and more about their health. Or whatever. With us, you use the doctor as an example. I mean, with us, if you're sick, you don't want to look at it at all. The financial markets after 2022, people don't want to look at their portfolio at all, and they just completely. It just hurts too much. It causes fights with your spouse. You just don't want to. It's off or on switch. That's it. And I think that the nature of our industry and the marketing approach of our industry being kind of an impulse buy and kind of a you can make a lot of money right now. I think that exacerbates that effect where, in a bull market, everyone's like, holy, I don't want to be the one to miss out. If you're, again, it goes back to kind of three avatars, or people think of it as kind of like three rings, where the core is your buyer that's always going to be there. The next one is the kind of good time chart, not the good, the fair weathered subscriber who's in there when things are going well. And then there's the outer band, which is kind of like the intellectual info seekers. And when the industry is firing on all cylinders and the economy is doing well, the market's doing well, all of those are there. And I think probably the biggest spender is that information seeker who might not even trade. They're just more interested in knowing what's going on so they could talk to their friends about it, or whatever that is. So I think because of the evolution, because of maybe FTC stuff, or just the toning down of the copy and just the way that the industry is going, it's kind of being forced into kind of a longer term, deeper relationship, providing a real experience, providing real value. And so I think maybe it'll have lower highs and higher lows. I think, if you can keep people a little bit more consistently interested in investing, instead of when there's a big bull market and there's all this copy that goes, that grabs people's greed glands. I think if we can tone it down a little bit and provide real investment approaches and real solutions and real money management, like your whole portfolio. I think that the people that have 10% of their money under their control want to have 100% of their money under their control. I just think to them, it's so far-fetched that like the concept of them being able to do that, the same way computers back in the day were so far-fetched. I could never be that person.
Right.
And I think the same has been true for the marketers, in our industry. I think that the industry has grown very much on the strength of the copy and the marketing, because there really hasn't been any other way to do it for, in the defense of our industry. There really hasn't been another way to do it. But I think because of the way technology is now, I think now we can come to the prospect with a little bit of more reasonable, toned down proposition and deliver a service that keeps the customer for a longer period of time.
Yeah, absolutely. And one thing I'll add to the I think that to the copy issues that we've had is that I feel like, and I haven't done a lot of times I'll do some like deep dive, like I have huge archives of everybody's going back 20 years almost to actually the 90s, direct mail promos and newsletters and stuff too, actually. But one thing that I think that the more common copy approaches lately have done, because of the bull market and because of how fast people were turning stuff out, we forget that people buy from people, and that making the big claims and getting super hyperbolic is something that on a standalone promo is way different and riskier than building up a relationship with the file with the guru, building up the personality, the person. The newsletter business started with kind of big personalities.
Yeah.
And we see this in social media now. Like, there's more people following Elon Musk than follow Tesla, right? It's not the company, it's the person.
Right.
It's like you have the person is much more relatable. And then if you can build up the person, then you trust and have a relationship with them. And then at the same time, we have these other things that I think about, where, like, I remember when Steve Fishman and Jeff Greenberg, who I talk about a lot because I love this story and kind of all the different things it says about our market. They're the ones that they helped, I think, Navalier, raise a $500 million fund pretty quick, and he got up to a couple billion off of a newsletter list. And they always say, like, this was really interesting to me, and it kind of speaks to something you said here. Like, people want to have 100% of their money in something. They don't want you to have, or if they're trading 10% of their own money, and most of the money is going to an advisor. And so what they found is, when they first started this, they had an AUM per customer of like 100 grand, because they were just offering the guru's portfolio. But
Right.
when they offered, like, all the stuff that's not the guru, the stuff that you would normally do in a money management firm, where you're like, or wealth advisor firm, where it's like, you have a bond pool, you have all these different things, then they went up to 850K as an average AUM. And I think that speaks to the fact that, like, no matter, like, one, we know on an engagement level, that guru model is really attractive. Two, we know that when you don't focus on the guru and you just focus on the promo, then you tend to get more hyperbolic stuff. And then you have the fact that, like, people, no matter how much they love the guru, they're not going to trust him with 100% of their net worth, right? Like, that's just not going to, in a newsletter, like, informational model. And so you have, like, a wealth advisor model is much more, like, one of the things that people believe in more than they believe in whatever you're saying usually is things like math, things like statistics, things like, hey, on average, if you do this and invest like this, then this works. And so they get excited about the things you say in a promo and things like that. But when it comes to, like, am I going to bet my life on something that's just some guy's opinion, no matter how much I like him? That's not as easy to do, unless it's like Warren Buffett. But it's Warren Buffett after he's Warren Buffett, not when he had his, there's plenty of people who turned him down and didn't invest with him early on. And so, like, you have this weird dynamic, right? Like, the guruship is powerful, like, it's engaging. Then you have, like, from a marketing perspective, like, kind of a weakness of not really relying on the guru. But then you have this reality of, like, I believe in tools, I believe in the technology side of things, the ability of that to help me be much better at everything that I do. And so it creates, like, these, I don't know where I'm going. I kind of lost my train of thought here. Sorry. But, like, you know what I mean? Like, these are like kind of like it's like the different balls we're juggling at any given time when we're talking about this, is that it's not as linear and clear all the time. What's someone's going to do, or what segment's going to be attracted to one part of it or another.
So what we're doing is it speaks to exactly that. What we're doing speaks to exactly what you just said. And that is, first of all, if you want to do heart surgery, right? In the late 90s, they said, okay, you're sick of heart surgeons screwing you over. Here's a scalpel. You could do this on your own now. And they're like, okay, well, I have the tool now, and everything just works itself out. They found that you need, if you're going to do something the stakes are this high, even if you're just going to do your own taxes, you want to have somebody there next to you, so that, like, he's the professional or she's the professional. They know what they're doing. They're going to watch me do this. It's kind of tandem jumping. You wouldn't just jump out of a plane for the first time by yourself, or maybe you would, but most people would. So we come at this from we want to teach you, we want to give you the tools to do it, or we'll just do it for you. And it's one underlying investment approach, and it's a technical investment approach, technical analysis, using price behavior, using rules. So it's rules-based investment approach. People can rebalance their portfolio once a month and do it. So if it's rules-based and it's a strictly rules-based investment approach, you can back test it. If it's a rules-based approach, then you can structure it in a certain way where the volatility level is either high or low. If it's a rules-based investment approach, you can just turn the gears and switch the knobs around till it's more custom fit to you. So the most important thing for investors to be successful is to do it in a way that's comfortable for them, because if they don't do that, when the shit hits the fan, as it inevitably does every few years, they're going to bail out on the investment approach. If it doesn't fit them, it's too volatile for them. And then they're back to square one in terms of that cycle that we talked about. So having an adaptive investment approach that adapts to most markets, having a customizable investment approach where you can customize it to your own time horizon or your own volatility levels or things like that, it's very important. And that's something that I think I don't see a lot of that. I don't know. I don't think there's a lot of that out there. If there is, I'd love to know about it. But all of the products that we sell, the subscription products that we sell, even the trading services where we have different gurus that have kind of different investment approaches, whether it be time horizon or whether it be using options or spreads or, whatever it is that they do, they layer that on top of the foundational investment approach that we have. All right. So they narrow down their trades to a small universe, basically filtering out most of the potential trades based on our rules. And then and it's a framework too. It's not just an approach. It's not just green arrow buy, red arrow sell. It's a framework for seeing the market clearly. It's just a categorization method for seeing the market clearly. So we teach them first how to see the market clearly so that their anxiety level is down. And then we teach them an approach that's customizable to them. And then on top of that, if you want to sign up for the trading services, I'm not trying to make this a pitch for subscribers who, but this is what we do. And it kind of speaks to what I think is best for the future and the players that are going to succeed in the future. If you could do something like this, our gurus have trading services that put their own spin on this one investment approach, but everything ties back to this one thing. So once you learn this one thing, you can take and do whatever you want to with it. You can do your own investment approach if you want to. So if we are, and because of the cyclical nature of our business, and because there's those three different avatars, we have the three things that we do: teach it, provide the tools, or do it for you. And then the three avatars, they overlap. Sometimes they'll do 2 out of the 3 or all 3 out of the 3. And we think that the best case scenario for people is to learn one approach, customize it to that, and then learn it, have the tools provided for that specific approach, not a big suite of 1,000 different tools like any online brokerage platform. I mean, tools that are specifically for this one investment approach. We'll teach it, we'll give you the tools, or we'll just do it for you. I think that's absolutely necessary. And that's why I asked you the question about the long-term path of our subscriber. I see them overcoming this sort of bully mentality. You can't do it, you'll never be successful. Like this bully mentality where investing on their own is so far-fetched in their mind. I think we're going to break past that point, similar to the computer thing that I talked about. And I think once people feel like they can actually do it on their own, I think if they can have a platform that's a destination platform that they go to regularly, and it's kind of like their home. Now you have a data platform that people are signed on for the rest of their lives, and it's customizable to them. I think that's going to be people who take that approach in financial publishing. I think those are the ones that are going to come out on top, however way they do it.
I agree. I almost think there was a period of time in the history of the business where it was like everyone was like, it's all about like finding the copywriter, and then it's like copy but media buyer. And it's getting to where it's devs, right?
Devs, yeah. You need if you're taking this approach of the platform and a destination site, yeah.
To your point on personalization, the only other group that I can think of that has taken an investment personalization approach is Tiffin, and it's a different model entirely. But within that, like if you think about this, like I think that within the macro trend that we're talking about of like personalization across every industry, that it hasn't hit, it's just starting to hit, we're at the early phases of that idea hitting the kind of wealth advisor, wealth tech world. And Tiffin raised a couple $100 million at an $847 million valuation on their last round. That was obviously pre 2022, around that idea of investment personalization. And whenever you have, like, just going from a venture model, like going from a cap raise, like kind of eye on things, or an exit strategy kind of view on things, whenever you have that big of a macro trend, you're going to have companies with different theses on how best to capitalize on that trend. And each one of those theses is super attractive to an investor, super attractive to somebody who's looking to acquire, because what they're looking at is, how do they're looking for a company to come in and kind of like prove a thesis, prove that, like, hey, on this customization or personalization side of things, like, we have actual customers who are spending money and we're scaling it up. And if you can prove that, it gets super attractive to an acquirer. It's super attractive when you're talking about raising money to go after some of these things, which is another big, I think, macro trend that a pure direct response marketer might hate, but it's just the reality of things, is that raising money and having the capital to scale is becoming an increasingly important competitive advantage, not just in our space, but across like the digital marketing, kind of digital entrepreneur world. It's like, everyone's growing up in business. It's just the way it is. Like, it's not just about having a marketing funnel. It's about like building a more mainstream business too, and raising capital, like getting the money to go after the vision that you're after, having the possibility of a exit, because is a real thing. Because in a pure direct response model, and we've seen this in our industry, we've seen it in health industries, we've seen it in every other digital marketing industry, there's all these businesses that push up 50 to 100 million, but there's no exit plan. Right.
Yeah.
And so what they do is they get this really great marketing machine, the engine going. And then the moment that their existing model gets undermined by changes in the larger marketing environment or market environment or regulatory environment, then the business kind of collapses. And then you have $100 million company that becomes nothing. That doesn't happen necessarily it can happen, but it does happen, but not as much if you have an exit path, right? If you're building something to exit, because building a sustainable, like, if you don't have, like, if you're building a sustainable, like, I want to be here for 50 years, 30 years, 20 years, you almost have to have an ecosystem model, because the individual business units will grow and die. It's 100% going to happen. Right. And so you're either building, my view is, you're either building one of these businesses for an exit, you're building it for a short-term lifestyle cash flow that you realize, right, well, is on shifting sands over, it may not disappear, but it's going to peak up, maybe hit a certain level, go back down, and then you just have a smaller business, and that's fine. Or you're going to build an ecosystem model, which is a whole bigger conversation about like what those models look like. But you kind of have to have a plan for what the business is going to be. And when you're talking about like tackling that customization plan, my head goes straight to, man, having a view and a thesis on customizing the investor and trader experience over time is one of those areas that we know is super attractive on both sides of that, the cap raise and the potential acquisition side. If you can prove out the model, then there's people who are going to be all over it, because that value to the customer, because the more personalized it is, the more efficient everything you're trying to do to that investor is.
Yeah, it's hard to prove it because I feel like it's something that hasn't really been done, but I think we haven't had the capability to do it until recently with AI, and you also have to have a couple key ingredients, like I mentioned, an adaptive investment approach and things like that. There's companies out there, first of all, you have to have a lot of cash if you want to do something big. The 50 to 100 million ceiling, I think, comes from a couple things. Again, these are businesses that are largely built on the strength of the copy and the marketing and things like that. A lot of times they have great products behind that and great services behind that, but the sales are made because of the aggressive copy. And those businesses are largely cash cow businesses, cash generation businesses.
Mhm.
And a lot of them are owned by a bigger company that has a big bank account behind them. So when the shit hits the fan, they can maintain for a year or two, and then until they start generating cash again. So that's kind of that model. If you're building something that's bigger, looking for some sort of as you put it, some sort of an exit. I mean, yeah, you need a lot of cash, because even just to maintain the tough times like now. But then what happens if you have a couple of promos at scale, God forbid, now you need as much cash as you can get your hands on as fast as you can, because that's why we're in financial publishing to begin with, because this is a business that can go straight up with the right promo. You need a lot of cash on hand. And if you're building your company to be around in 20 or 30 years, which I'm not sure if I'm doing that or not. I mean, I could very well end up being a company that's around in 20 or 30 years. But you have to do it in a way where you're going for those long-term relationships, in my view. If you look at MarketWise, MarketSmith, which is owned by Investors Business Daily, and they recently got bought out by News Corp. They have that William O'Neill CAN SLIM acronym that a lot of people know about and sign up because of IBD. Kind of gets them. IBD is kind of like their front end, and then they sell them into this data product. I've subscribed to that since I think 1999 when they were Daily Graphs. I'll never let go of that. Dorsey Wright is another one. They got bought out by NASDAQ. I'll never let go of Dorsey Wright. Investors Intelligence and Dorsey Wright, they were bought by NASDAQ, and I spoke with the guys at NASDAQ in the past. I don't know how much I can say or not, so I spoke to them in the past, and I know that they have an interest in having more of a presence for the self-directed retail investor. It's, Dorsey Wright is a company that has a platform. They have an investment approach. It's very similar to what we kind of have the same origins. We come from the same place. But their focus is on registered investment advisors. So they're institutional. And we could get acquired by a NASDAQ, let's just say, for example, because we have that retail exposure. I think you're going to see a lot of other scenarios like that. We have places that used to focus on institutions focusing more on retail. So NASDAQ has Dorsey, and Dorsey sponsors all these ETFs and mutual funds. I think they have like 15 of them, or maybe 20 by now. And they want individual investors to like those ETFs and to like those mutual funds. So they want more exposure. The fact that we have a similar investment approach, I think we would be a perfect fit for a buyer like NASDAQ. Honestly, John, like I want to change the world. It sounds corny, and it sounds like people saying what they're supposed to say or whatever.
Right.
I hate everything about financial services and financial public. I don't like the landscape. I don't like the way it is. I don't like that individual investors kind of get the short end of the stick. And I keep kind of defending the industries, the various industries. It's like, you haven't had the technology up until now to provide an experience that takes all the different puzzle pieces that are sold right now and puts them all together in one cohesive kind of plan. And being an investment advisor, I know I can't prove to an investor because there's no example of anybody who's done exactly what I want to do that it works. But what you can talk about is, as an investment advisor, right? Completely different company, right? Registered investment advisor, Avalon Invest. I know that the most important thing, right? The most important thing to keep an investor in your investment approach before they even get into it is to understand that customer, understand their volatility appetite, or the risk appetite, or what kind of volatility they can withstand. I know that my investment approach is going to underperform every few years. Like that, there's no way you can have an investment approach that outperforms unless it also underperforms. So I know it's going to underperform. So my conversation with my investors is, look, you're investing in an approach. You're investing in a set of rules. Forget technology, forget fixed income. We're doing a bunch of stuff. We know the price behavior, and this way of life, relative strength investing, it's going to underperform. When it does underperform, how bad is it going to get before you say, this is too much for me? And we want to stay away from that. Like, I know that that's a fact, right? People, I can point to the biggest reason individual investors underperform being performance chasing, right? I think Tom Dorsey calls it the Sports Illustrated cover curse. When the athletes on the cover, they've peaked. That's it. That's always their peak. Investors chase performance. So they look at the fund manager or the ETF and they say they've done well, I'm going to go with them, and they buy near, they underperform. So that fact that has been proven a million times over kind of is the argument for what I'm saying, which is, number one, find something that you can customize for your user and make it so that they're investing in a way that's comfortable for them, but still it's not some other investment approach. It's our investment approach. So it's a unified thing, and they've got a community and they know that everybody else is doing it, but they're doing it in the way that they're comfortable with. And if you can do that and sell them data and tools, basically the reading glasses, I think you've got a long-term customer. If you do it that way, if you do it, and that's the real way to do it. And now it's not just their play money, where when the market kind of washes out, they say, fuck this, my 10% that I manage, I'm not even going to look at it anymore. Instead, this is all of their money. They can plug their brokerage accounts, or they can plug their investment advisor into the platform. They can see it through our lens. And I think when you do that with you have to be a little bit more of a fintech company. You have to be a company that has a platform that can pull in price data, that has a lot of capabilities that right now nobody in FinPub really has. Frankly, most of the internet, I think, is built on WordPress websites, right? So with that, you can't really provide this customized experience. And with all that you can do now with AI, our customer experience is twofold. It's the marketing and it's the fulfillment, right? So if we can monitor their price behavior on the platform, we can both sell to them in a way that's targeted. So we're not like annoying them. They have to watch an hour video to get to the point, and then they realize they don't like it or whatever. It's customized marketing and it's customized service. And that kind of almost bridges, I feel like I'm taking a big risk by saying this, but it almost bridges the gap between investment advisor, RIA, and financial publishing, where publishers have their publisher's exemption, all right? And again, publishers' hands are kind of tied. This is what I'm saying when I say like they use hyperbolic copy. It's like, well, what else are they going to do? There's laws. We cannot customize the experience to them too much, or else we're an investment advisor. Well, now with AI, you can kind of automate based on their behavior and what the symbols that they're entering and the stuff that they're clicking on. You can kind of help them, long story short, have a customized experience with an approach that's proven to work, a billion times over. I know I just said a lot there, so I'll stop.
No. I don't disagree with you. I think that's
it's complex. It's going to be hard to be I think the best out there. You need a lot of different ingredients.
That's what I mean when I say like the dev piece is becoming increasingly important, in that like it or not, like we're an information business, and AI tools and AI backed tools, or like that's going to become an increasingly large part of the market. People are going to build those tools outside the industry using AI, and they're already doing it. And so people who don't start to look at this, like the market can grow and FinPub can shrink, because it's not always, you can't assume that the product and marketing model that is working today is going to be the one that's going to grow with the market. Like a rising tide lifts all ships, but it lifts some ships more than others, right? Like, and so I do think that you're absolutely right. Like the building in that direction and bridging that gap, because it has, it's like the publisher's exemption closes off a lot of things that you could do, and it frees you from a lot of things that a lot of risks. And so it's like been like this thing that has been beneficial or not. But
the number one most important thing is giving them
but a SaaS platform, getting into like how you market that is different. Getting into like if you move into let me back up. Non-FinPub marketing, like long form direct response marketing, I hate to say this, it works. Okay, it works different, but there's this assumption that, oh, like you cannot sell if you don't use this particular model. And it's like, no, that's not true at all. I mean, like, there's trillions and trillions of dollars in the economy that proves that that's not true. And on a scale of like what's worked like in mass versus what's worked in kind of a direct response model, like direct response is one of the best bootstrapping models in the world across any industry. Like, find a product that works, can you sell it? Like, that is the thing. But a lot of companies that started in direct response expanded out of just direct response into larger market and larger business models, and use that as a fuel to do that. And so I think that like we can forget, or we can be very, very, as an industry and as a subculture, very derogatory towards any other type of marketing. And
all right.
it's
because you get the big product launches as opposed to like what the YouTube that channel that gets, you know, millions of.
Hey, it's like you said, it's a cash cow, right? It can be a cash cow.
Yeah, but also the rules that we follow, the stuff that's worked, you know, that's not sustainable over the long term, in my view. I mean, human nature doesn't change, so the different marketing rules will always work. That's not what I'm talking about. But I'm talking about the hyperbole, you know, the customer that kind of just doesn't want to change what they're doing. They're the older people, and let's face it, you know, over time, you know, everybody has their expiration date, you know, and so I think a lot of the people that accept that type of marketing, you know, a lot of them will be out of the game, you know, just because they're just not in charge of their investments anymore. And then you've got new people that are in their peak earning years that are used to lots of authenticity and transparency. And, you know, so I just think that the same rules and what we followed, it's been kind of like an if it ain't broke, don't fix it sort of an attitude. And people are afraid to let go of the side of the pool and swim, you know, and do these new things because this is what works. And you've got an industry full of people that if you know, that's what's worked. And so you've got a big industry full of people that know that thing that sells to that person in that niche way, that niche product, that niche approach. Okay, well, if you do something new, now you can slice all those people down to about 15% of those, you know, because they all know how to do it. 15% are willing to do something different and are going to change.
Yeah, no, I see that the same way. Like and I'm not saying that everything, like, you know, you said it earlier, the other model doesn't go away, the existing model doesn't just disappear. But I do think that we'll see here's how I think it's going to go, is we're going to be hearing more and more new success stories in kind of different alternate models than we're going to hear in new success stories in the old model. It doesn't mean there won't be success stories, but you know what I mean? It's just going to be like, you'll see that trend, and then you'll be able to track your own revenue. Like, are your campaigns, like if you tracked it like year over year, are your individual campaigns, are you getting higher highs or in higher lows? Or are you getting lower highs and lower lows? And obviously 1 year, 2 years within the cycle can change that. But if you're tracking that over time, like you can tell, like over time, you'll start to see, I think, that there are going to be different models. There are going to be different, even just like looking at social media models, the e-letter model, right, was revolutionary in 2000. Right
in 2000, right.
We moved from direct mail into a digital environment. All of a sudden we had an e-letter model, which in the beginning was literally free to send. It felt free, like, and digital acquisition costs have gone up now to where like we're paying more for a customer than we used to pay in direct mail. Like the whole environment has evolved. The free like content model on the front end has moved largely to social, to video content, to other things, which is uncomfortable too, right? Because that's a switch. It doesn't mean that email's gone away or is going away, but it changes the way that you kind of work on the front to put stuff out there, like and to engage people, because they're always chasing engagement. And like you can, like you have your ideas, you have the market, and then you have the formats. And so like all these things are shifting, and I know people, it's like I get I don't say negative comments. It's like everybody comes at me and says basically they agree with me too. This sounds awful. Like the fact that you have to change, like you're you have to change like the way that you're looking at it. And it's not like a cut everything off, but it's like you have to be aware of these trends and start to see and explore how you're gonna adapt your business within them, I guess.
Yeah. Yeah. You've gotta dabble at least in these other things that I mean, I have a very, anybody who's watching this at Chris Rowe, sign up for my YouTube channel. I've got a very small, not very widely followed, YouTube channel. I think the people that are doing it right are going to see, a huge spike in renewals and, and the YouTube people. I mean, Mark Moss is a great example. Mark Moss is he's approachable. He's explaining complex stuff in a very simple way. If you just deliver a good product, ultimately, I think you're going to be successful. I met Mark Moss at one of your at a Jacksonville event of yours, actually. And he impresses me every time I watch this thing because I mean, if you're just to the naked eye, to the regular person watching it, it's one thing. But I know all the different things he's thinking about while he's doing what he's doing in the presentation and make it simple for people. I mean, it's he talks about the macro issues and he dives deep into these things. And like, it's so impressive how like I think anybody can walk away from his stuff and go, okay, I get it now. Other people with different models, like you said, Tiffin, JC Parrots, All Star Charts. He's doing something similar, but from a technical analysis perspective as opposed to macro perspective. So I'm naming people who do the right thing. Josh Brown is a very well-known CNBC contributor, but also big money manager. I follow people like that: Josh Brown, Mark Moss, JC Parrots. These are people they're delivering a good product. They're saying things that are very real. They're not full of shit. When you watch CNBC, you watch Josh Brown speaks, and then it's like a relief. It's like, all right, well, everybody's kind of rigid, everyone's trying to do whatever every now and then they go outside of their lane. And Josh is just like, he's the guy who's like, fuck this. I'm not gonna buy this bullshit. I'm gonna tell you exactly the way it is. And I think that, and you see, he's the most widely followed, I think, investment advisor, or maybe the most widely followed financial guy on the internet. He started out just by writing blogs, and then CNBC contributors were going to his blog, reading what he's saying, and they would kind of regurgitate. Eventually they called him up and they were like, hey, why don't you come over here? So just deliver, quality shit. And even if you don't have the freemium, destination platform and all that stuff, that's my way of doing it. It's just kind of what I know, everything that I've built in this industry. I didn't get into the industry to say, how do I build a financial publisher? Instead, we say, hey, we do this thing. How do what model can we use to get this word out? Thinkorswim was wildly successful because they did the same approach. They built something for themselves. They were using it, to trade their own stuff and to be market makers. And I said, this software is sick. Let's build a brokerage firm around it. And then they got bought by TD because the software is so sick, and also they have some AUM, whatever.
Right.
Then that was Sosnoff, and they went to Tasty Trades, and the same theme that runs through all this shit is deliver a quality product, do the right thing, be authentic, and you'll have your audience. This particular way that I'm doing it, a SaaS product, fintech, a freemium website, destination website platform, that one foundational approach that you can, I feel like that's very specific to me. I think there's going to be many ways to skin the cat. And I think all of them, the same thread that's woven through all of them is authenticity, bring people quality product. It sounds like I'm pitching that just because whatever, but that's what works. If you look at what's working, that's always what works. I remember at that Jacksonville thing, I think Mark Moss maybe had like 70,000 people. Now he's got like 500,000 subscribers to his channel. So yeah.
And that's another thing too, is that when you talk about the CNBC content, how we're seeing this other trend, like kind of reaching, this is where when I talk about the mainstreaming, you can look at every one of these other more mainstream financial, either information segments or financial industry segments. And what you're seeing is they're reaching in the same directions that we're reaching right now. So when you talk about like an authentic content piece, most content that's being produced on like a corporate level is corporate as shit. And it is like press releases, it's generic conversations. They might have some conversation. It's you see very few people like that who actually are like really good, really smart, really engaging, and who are really authentic, are crushing it. And I think what you're going to see is more of those people keep coming out of the woodworks over time, because every time there's a big layoff at Goldman, every time somebody is successful in their career and they're ready to make a change, the go-to model anymore is I should have a channel. I should be creating content somewhere. I should be building an audience somewhere. I should be out forward. So people can get to know my view. It's part of how you build a career, even if you're not an entrepreneur anymore. And so we're going to see, and we are seeing, and this is going to be one of those things that just changes over the course of the next 5-10 years, not even that long, 3 to 5 years. You're going to see more and more really good, just media content producers around financial, all aspects of it, like not just trading, but like M&A, banking, like CFOs, like, or, you know, like you're going to see an increasing amount of really great high quality content coming out, fund managers, everything else. And so that's going to be like more eyeballs, more business opportunity, but also more competition in terms of attention within the investing space. And so like we're mainstreaming because we're moving towards content first models across the board on in financial markets. And so that's, to me, that's like, it's kind of like start to play with this, start to look at social, start to look at different content models, look at things like Mark Moss and what he's doing. And if you can't move in those directions, you'll be increasingly passed by people who do. It's uncomfortable, like changing. Like I didn't create content forever, and I'm not very good at it in the sense of like the marketing production and everything like that. I like having great conversations with people in the industry, and we're a niche business, so, but it's important to me on principle that I need to be doing this too. Not because I expect to build a huge audience, but it's the way for us to, like, you can see, like, to what you're saying before, it's like the way for us as an industry to start having conversations that allow us to kind of do things and think about things in different ways. And it helps us all. And that's happening everywhere. You know, people hate Gary Vee in our industry. Not everybody, some people do. I know, like Brett. But I'm like, that guy called it. I remember meeting Gary Vee back in, like, what was it, 2008, 2009, maybe a little before that. Maybe actually it would have been 2007 at the latest. And he spoke at an internet marketing conference. And I remember sitting there afterwards, and there's a bunch of us talking to him afterwards. And this is when he was still Wine Library TV, before he started VaynerMedia. And he had all the list of all the internet marketing gurus were up on stage at that event. And he's like, you know what? These fuckers, pardon my French, they better hope I don't get into this business, because I would crush them. Because he's looking at what they're doing, and he's like, and they're missing the bigger picture. They're just pitchmen. They're not really thinking about the quality of the content. Like, and sure enough, he comes in there and he crushes all of them in terms of success, right? Like, and he's got 10 million followers here, 10 million followers. Like, he's huge. Because he was like, you know, you just put it out there. You have to be authentic. You have to be real. You have to have actual success. Like, you can't just like, you know, and the stuff that he taught, for instance, is coming to our industry, because again, we're always behind the rest of the marketing industry by the nature of financial customers and models. So
content first people. I think lately, I think Addison Wiggin is now becoming huge. I mean, there's always been, you know, great with content. Addison Wiggin, Porter, right? I think that's really what it comes down to. I think you can make loads of money on just like a podcast, even, you know, just bring something that really works. If you have a rules-based approach, I think even better. You know, it doesn't have to be mine. It can be anything, because then the marketing that you're doing is showing back tests of a rules-based approach. Like, there's no arguing it. Like, this is what happens, and it spits out regular alerts. People also trust, like you said, you know, I think you mentioned earlier that, you know, having a guru there to kind of lead you is helpful, but it only goes so far when they might not want to put all their money behind what some guru is thinking. But if you can prove that you have an investment approach that does work over time, and you can show the back test and the history of it, and you give them 12 versions of it and pick one that looks like it's best for you. And then you have a guru that's also kind of hosting that. uh, I think that's the best way, because they'll believe in the investment approach. And I think also this wave of new technology, new AI stuff that's coming out, I think people are their minds are gonna be so blown by that if you have something that you can sell that has a legitimate claim that it's using AI to find, to navigate you through the market. I think people are gonna be so blown away with all the things related to AI. It's gonna kind of be like .com back in the day, where they say, this is, I've got to sign up with this. I think you can get a lot of customers if you can say that you have an AI based thing. And I think you'll probably see a lot of that too. It might be sophisticated AI stuff, or it might have a drop of AI in it, and then they can say it in the copy. But I think that people are going to start to really gravitate towards those things, especially when you get a bit of a stronger market. I think that one of the keys to having a long-term subscriber, let's face it, if you're pitching them with hyperbole and you're pitching them the big gains, then the big gain market is all you're going to keep the customer until it's not that anymore. The key to keeping them over the long haul is to let them see the market clearly with data, with a platform, and to make them confident enough that they can either apply it on their own to all of their money, or that, like you said, they can check their investment advisor with something that, they think can apply to more than just their play money. If this is not just applicable to my play money, but it's applicable to my major portfolio too, then there's no reason for them to run away when the market gets beaten up. But again, you're going to have to alter the business model in a way, and think about getting having the customer for a longer period of time. Maybe you'll have a bigger LTV over the long haul, maybe not so much right up front in the first week or 30 days, and then it goes like that. Maybe you get a pop, and then it tapers off a little bit less, but has a much longer tail. But it all comes back to, like you said, content first kind of mentality. There's going to be a place for the marketing first, and you can't have a business without marketing. So, but I think the ones that are doing it the right way are the ones that are going to have the majority of their revenue come from renewals, as opposed to those big. I think that's what, that might be what it comes down to is the majority of your revenue coming from renewals, or is it coming from that initial sale, right?
I think that difference is that idea that, like, hey, your money is on the renewal, because that's the converted customer, the guy who's happy.
Right. It's always been the measure for us as financial publishers to see how well the product is doing is going to be to look at the renewals. Right. So if the idea in succeeding in financial publishing, or whatever we evolve into, if the idea in succeeding in that industry is to build a deeper relationship that lasts longer, then the main metric should be the renewals, right? Since that's what it's do directly.
Right. And it's kind of like you think like the Wall Street Journal and other things, like it's an information and news source, opinion source, about markets. And if people are finding that valuable, then they stay. And then if you have like really aggressive marketing that is better, in some cases, either better than the product or misrepresents the product, because that can happen too, then you're going to have a lot of fall off right out of the gate. And people aren't going to be happy, and you're going to get really pissed off customers.
Yeah, what's interesting with William O'Neill and Investors Business Daily and Market Smith, their data product, they don't really I don't see them marketing that at all. I mean, I'm their primary target customer. I own it, but I think I would have seen a lot of marketing for it. The customers just come from reading IBD and just being trained all the time to read the news in the context through the lens of this CAN SLIM acronym and things that they look for. And they have all these different technical data points in the back and the middle of the paper that people kind of get trained on, and they're just trained to see the market a certain way. So that's pretty interesting too, that they're just delivering, again, good content in a different way. It's technical content, and they have sort of the story around it that supports the technical picture, which is kind of what we do. And it's just another way of doing the right thing, putting out strong content, and then kind of the rest, kind of takes care of itself. And as we go into a more mainstream audience, which again, it's not just about evolving with the times or what's the next big thing. You got to think about the fact that, your customers as a traditional financial publisher, generally are older people. and you have this new, this new wave. So it's a shift in ratio and where your money's going to be coming from. So you got to plan for that. You can't just, decide one day. It's going to take 3 to 5 years to pivot from one kind of a company. Take it from me, because I've been building the technology that we have right now, started like 3 years ago, from a marketing, MarTech stack and the product platform. And we just launched MVP. So even what the public sees right now is like the first crack at it before we start tightening everything. Everything that you build, the foundation of the building takes forever, and then all of a sudden the building kind of goes up overnight. That's if you want to build something and you decide that you want to build something for fintech and uses price data, historic price data charts, and make indicators and shit like that, you're going to have to start building right now. So I would just encourage everybody who's thinking about getting into data, start doing it now, because you're not going to be able to launch it for a couple of years.
Right. Which means it's hard because you have to make a big upfront investment.
Yeah. Or you're going to partner up with somebody like me, or you're going to partner up with whoever, somebody who has the right technology to build those kinds of products. So I don't know, maybe all this headache will pay off, and I'll have, what do you call it? First arrival advantage, or whatever they call it.
First movers advantage.
Yeah. First mover, right?
Yeah. No, that's good. I guess let's change tax for a second, because I think the other big thing that I want to get your take on is kind of something that we alluded to earlier, which is like kind of the FTC environment changing.
Right.
It's one of those things where, in this broader trend of financial publishing, financial media, financial markets, all kind of reorganizing a little bit how they interact with each other, with themselves, with media. What we have is kind of a clashing of two different regulatory frameworks, right? Publishing is purely regulated under the FTC, and everything financial is under the SEC. And I do think that one of the things that was very surprising to me was a comment that Damon Wright, who is a FTC lawyer, mentioned on one of the interviews that I did with him, where he talked about like how fundamentally different those two regulatory environments are, to the point that he was having a conversation with a lawyer from the FTC, and they were pointing out a disclaimer that was on a page that said something to the effect of, hey, all trading and investing involves risk. Past performance is not a guarantee of future results. And the FTC lawyer was looking at this from a purely FTC kind of regulatory framework, and said, hey, what you're saying there is that your product doesn't work, that you will not get good results in the future, that the past results have nothing to do with how good you are. And all of us who are kind of familiar with markets realizes, whoa, like,
that's what we've been using forever. Everybody's been using that forever.
That's the SEC.
That's what the SEC looks for, yeah.
Right, because the SEC is like, you have to have that in everything, because the reality is that you're navigating shifting markets. You can't, like, what worked in the past, like, it's an evolving like ecosystem. It's an open ecosystem that's always changing.
The key word is guarantee. They're saying that what happened past doesn't guarantee what's going to happen in the future, which to me has always been kind of an obvious thing. I mean, if you don't know that, if anything, you should just put that just so somebody can't walk into arbitration and, say that they thought it was a guarantee. I mean, it's almost like a throwaway statement. It's kind of a given, but people put it there because they want to cover all bases, I guess. And it might not apply to the FTC, I guess.
But to me, it is really interesting, not because of, there's a lot of things that the FTC has said and done that pisses off some people. A lot of people in the industry have said is really good. There's like a lot of things that's going on there, but to me, there's this underlying, like, almost deeper difference in understanding of what a good or a factual statement is versus in those two different regulatory frameworks. And so it's like there's these two different languages, and I think that those two things are going to become increasingly at odds over the next several years. And like, how do I say this? It's very easy for us to get pissed off at the FTC. And I think that, there's people have good arguments for like some of the things that the FTC has done that isn't as, I would say, there's not as much nuance. It's kind of like they've decided that you're, you get the notification, they've kind of decided, and you're basically going right to a settlement. Like you're going to pay money. Like
Yeah, and I hope that it doesn't become that way so much. Kind of the SEC is kind of known for, just leaning on people till they pay the fine, and it's they give themselves a lot of leeway. There's a lot of flexibility for them to, they kind of have their rules written in sort of a generic, open-ended sort of way. You have to call them and ask. You have to get a letter written saying that you asked them, or you have to prove that you asked them and they didn't respond to you or something. And they leave themselves a lot of room to just basically say you're in the wrong. There's nothing you can do about it, and we're going to shut you down or pay me. Right. I don't know if that's still the case with the SEC. I remember it had been a while back that they were a little bit more like that. And
it's a common complaint with all of the regulators in that sense. And I don't think it's kind of like almost unproductive to, like, you can't fight City Hall in one sense. I do think that, like, I wish that we had more education from the FTC. I know that in the past they used to come to conferences and kind of help people understand, or at least the legal conferences, and help them understand.
And that's great.
Yeah, they've really pulled back from that and focused more on enforcement, I think.
So they haven't. So they're no longer going to the conferences and educating the.
Yeah, I talked
on how to behave, or
Damon mentioned that they'd stopped or dramatically pulled back that piece. But I do think that, like, the, like to your point about brokerages and kind of the evolution of markets earlier, there is this kind of need for kind of a self-correcting function, right? Like where that there's going to be bad actors in pretty much any business environment, or any human environment, I should say. There's going to be bad actors, right? Like you put people someplace and there's going to be some that aren't great.
Well, we're in a great industry. I say I dislike parts of its norm, but the norm is constantly evolving, and it's been in an upwards trajectory in terms of the products and the services that we sell, in terms of the authenticity. It's been an upwards trajectory, and especially in terms of the fairness of the marketing by financial publishers, fairness to the customer. And a lot of that's been a function of the FTC. The marketing now is fair, or if anything, it's fair from our side, the side of the publisher, the research firm, and marketing has become way more reasonable. And if anything, it's skewed a little too far in terms of what the FTC pushed for when they changed the standards. And, I'll say that the industry adjustments only bring about good things as long as we have some time to kind of digest it, because, you've got an entire industry of people, thousands of people that are adjusting to their new standards. And if they really want to make the world a better place, if they really want to help, the customer, what they'll do is they won't be too relentless with the regulations and going after people. Because then if you have these people that build these companies, these founders have started businesses, they've been in the industry for 30 years. These are strong, people with perseverance and intelligence, and they know how to run the business, and they've been evolving with the industry. So if you demoralize those people, they're going to leave the industry, and then they're going to do something else, and then bring their talents to that industry. But you don't want to do that as a regular. The FTC is probably watching this, so I would a message to them. I'd say, if you go about this the right way, you will be really helping the people. Let the people who run these businesses, these are savvy people, let them digest this, because in practice, in reality, it takes time for it to flow through to the industry. Everybody wants to just know what it is that the FTC wants us to do, and if they're not going to those events and educating companies on what they're looking for, I think that they should consider going back to that, because I think it's just healthy. So, we don't want to evolve the right way. I think, ultimately we all want to do what's right. We are always competing with each other, so we're always going to push it, pretty far and within whatever the confines of regulations allow for. So, I mean, the best players, honestly, the strongest people that are equipped to evolve an entire industry and pivot kind of from what we are right now into what we want to move into. I mean, those are the people that are probably making the most noise in terms of making money and growing their companies. They're successful people. They're smart, so those are also the ones that kind of might get scrutinized by regulators. I'm just saying you gotta let that talent breathe a little bit, because those are the people that will run the ball down the field to where you really want it to end up for the customer. Yeah.
Yeah, well, I think that's at the end of the day, it's kind of like there's people everywhere who are, especially in the industry, who are focused on the customer and making the best experience for the customer, best outcomes for the customer, that they're or having their business be positioned to help provide the best outcome for the customers based on where they are in that customer's kind of decision-making value chain. I think that's it, is that the FTC wants what's best for the consumer. The best players in the industry want what's best for the consumer, and we want to be able to provide it. And a lot of us have very strong opinions about what product is best for the consumer. And the consumer has their own opinions, and theirs is the one that ultimately matters. There is a lot of things that the FTC clamped down on that you're like, okay, like that's not unreasonable, right? It's not unreasonable to have a net impression effect. It's just that we need to understand what the net impression kind of means, because it can be very vague. And there is there have been people who have gone too far down that marketing road of kind of get rich quick versus hey, but there's a difference between that and talking about markets which are related to money and having a frank conversation about it that is interesting and engaging and exciting.
Risk exists. Everybody knows risk exists. I mean, there's a reasonable middle ground, We're not guaranteeing profits just because we're saying what has happened in the past. And I think everything that gets marketed, Red Bull doesn't make you fly. It's not it's your wealth, that's your health. But we're not out there, pretending that everything that we touch works. I think everybody is pretty much on the same page now with their marketing, saying that everything has risk, don't invest more than you can risk, things like that. I've heard everybody's marketing lately says stuff like that, and says some people lose money, everybody has a different experience. I think we're pretty much there. I don't know how much further it can go.
That's the thing, is as long as it's very clear about those things. And a lot of times a promo, it's not working because somebody said that. That's the funny thing. That's again a little more authentic. I think the promotional environment is just soft right now. There are things that are working that they're based on
you mean not because of regulations, you mean just in general? There's not really really seen any hit movies coming out lately, no blockbusters.
Right. It's already soft for non-regulatory reasons. And then I think the regulatory changes, I do think that they kind of make some of the things harder for people. But I think I keep saying this, that there is a little bit of it is the different copy cultures that have been kind of dominant have trained a lot of writers to write and think about copy in a certain way, that in those things have just, you can't say some of those things. You can't make something that's all about the fact that you had 1000% gain 10 years ago, and that's the center of your copy. Those kind of things take time, to your point about evolving. The way this works is the publishers, but also the junior copywriters and the mid-level copywriters, they have to evolve. They have to learn how to sell within that environment change without relying on things that they can't say anymore. And so it takes a little bit of time for people to kind of get back to where hey, this is a framework that works. I go back to lots of other old promos, magalogs and things like that were blockbusters. They didn't necessarily rely on kind of cherry-picked wins all the time. There have been some great promos out there that are really just well-crafted market stories. And so it's a bit of that return to actually selling the investment thesis.
Right, which any good copywriter I think is already doing. It's when you go through these cycles that the market brings us through, you get people that have the skill but become lazy, and you also have people that aren't really that skilled but they're successful because they say buy the next stop, it's going to 5x. So there's all, that's the same old story. The younger writers who've actually never lived through cycles kind of don't have a good idea of how the customer mindset changes. I think the best copywriters are going to be people who have been in the Wall Street industry and spoke to people directly one-on-one, because that's your customer. That's who you're writing to at the end of the day. And you go through different cycles talking to them. You see how their mood changes. I think you got a lot of people, if you're trying to write those breed packages right now, it's not really what people want to hear anyway. And then when you go through easy times when markets are breaking highs, and then you go through a really tough time like this in terms of sentiment, the way that market sentiment dropped. You've got people that thought they were great copywriters, and realizing that you have to have a little bit more substance, and and I mean, if you want people to keep reading, especially because that carrot's not going to keep people reading anymore. If I'm going to 10x my money, right? They want to know what's happening. They think about the bank crisis, a lot of stories happening right now. And there's a lot of opportunity out there too. There's no shortage of stories. We just actually had a pretty good promo pre-launching Tobin Smith. We didn't even write anything. I got on a webinar with Tobin Smith, and I said, hey, we're going to launch your thing in 60 days. Let's talk about the banking crisis. We can't wait for you to have a nice shiny product, with a website and everything. So we're going to have everybody on a webinar, and you're going to start emailing them every week. Tell us what we should do. And it converted really, really well. So I think there's a lot of potential out there, and people have to be willing to try new things, right? Maybe work on the fly and ride those news waves, those news cycle waves. But yeah, there's no shortage of stuff to write about to get people's attention without saying I want to make you 10 times your money.
Well, I think that's it too, is that I do think that like, for me right now, I almost feel like there's a cornucopia of amazing ideas out there in the markets, like macro ideas. I mean, there's like these, like, we're talking about like some of the biggest geopolitical and macroeconomic kind of like shifts in decades.
Big time.
And those are stories.
Yeah.
And I almost feel like part of it's also maybe how we look at franchises. Like you take like just the conflict between Russia and Ukraine and kind of how it's playing out across the supply chain. Mm-hmm. Like you could build a franchise around that, right? Because its impact on business and companies and stocks are so enduring. It's gonna be here for years. There's so many different stories. It's plugged into the news, but it's not like a pure just hey, this is going to go up here and this is going to go up there, right? And it's not a pure story about a single sector like cannabis or crypto,
right?
It's kind of what we used to do in the early, like, this is like the BRICS copy, right? There used to be these great promotions around like the rise of China and how it's going to play out, and those were fantastic promos. But we haven't had to write those promos for so long.
Well,
that it's part of that copy culture thing. I think that people have to relearn how to write some of those things.
You have to have a passion for writing. I think a lot of people, when you go through these bull markets too, I think a lot of people hear that there's a lot of money to be made in copywriting, so they dive into it because they want to make a big paycheck. Mm-hmm. And they're deep in their heart, they're not that interested in writing or in sales or in the psychology of it. I mean, if you don't know who the wizards are, if you don't have an idol, if you're not, some people aren't full-fledged copywriters. They want to make a bunch of money. They like the lifestyle. And that's what a lot of these copy schools or whatever will pitch, is the lifestyle, work from wherever you want to, travel your whole life. They're not fascinated and obsessed about the craft itself. When you have people that are like that, they never really stop. Even in the bull markets, they continue writing in the way that they want to write. And like Dylan Jovine, is co-founder of Tycoon Publishing with me. He writes, he's a copywriter at heart, and he writes stories about real shit that's going on. And he's not really selling you, he's just telling you about what's going on. And it's like, the way he tells the story is captivating. He has a promo that's been working, various versions of the same promo, about China having their guns pointed at Taiwan, and all the power shifting that'll happen because the semiconductors, they're in control of 90% of the military semiconductors and 2/3 of the world's semiconductors. So what does that do? People like that. There's other people I had in mind, but they slipped my mind. But I mean, those thinkers, those are the ones that are always going to write the good packages, because
I saw a great
sells itself.
I saw just a news headline the other day that like made me think of what a great promo that would be, because it was basically the idea that the U.S. would rather bomb Taiwan's semiconductor factories than let the Chinese take them over.
Like that.
And then, but then think about that. Like if you own those stocks, like
that's a sick idea. That's like that there's a movie
great.
like that where they destroy Fort Knox. They take all the gold that's not at Fort Knox, and then they eliminate Fort Knox or something.
Right, but I mean that's what I mean. We're talking about like the ideas of like trying to dimensionalize like great copy and great editorial is dramatic. It's story, it's people.
Yeah.
And right now we have one of the most high drama global environments that we've been through in a very long time.
Yeah.
And like you can sell greed, and it's not quite right that you're selling fear. What you sell when you're not selling, like, it's greed, but you're selling confidence. You're selling like
right. You're selling
to navigate.
A reduction in anxiety. Said differently.
Yeah. And people are all about that. Like there's a lot of great stuff, and it's really engaging, and like I feel like we're in an idea rich environment for promo, and I see so few promos being written about some of this stuff that it's remarkable to me. I mean, I've even thought about doing just a promo idea meetup with a bunch of copywriters and editors that just kind of like, let's do a review of what's worked in previous bear markets, copy wise and promo wise, and then dig into what's going on today and start to get people thinking in that direction.
I know in Baltimore, my copy chief, Brandon Thompson, he has Fridays, like a happy hour for copywriters, and every week it gets bigger and bigger. And a lot of people are going there now. It's not exactly a meetup to talk about business, but they'll be all compared paycheck sizes and stuff like that. So anybody want to reach out to him about that? So we have Tobin Smith now. And so he's a macro guy. He's writing about these big transformative events that cause all the different industries to do all types of different cool things. And he focuses on, especially on small companies, micro caps or small caps that are affected by these giant, huge shifts. That's something I'm really excited about. I just wanted to brag about that one more time because he's the story guy. He's the macro guy. That's the kind of copy we need. We're technical people, and we have this framework, and this price behavior. It gets wonky for people. But having Tobin Smith with us now, we were in the studio with him all week, actually. So stoked about that. I think anybody who's just writing what I'm not going to say what this. I was going to say what this person called. Like, there was one copywriter who was calling it mouth breather copy. So it's basically like big bucks, no whammies. You're going to make money, and and that's what was what was hitting in 2021. I say copywriters listening, if you're listening, just make sure you read the copy books several times. All the marketing books several times. Breakthrough advertising, great leads, all the different copy with a highlighter, and make notes and make voice memos, and watch on insights that Mike Ward discussion that's on your website is amazing, right? All the things not to do. Just get obsessed with it, and write stories, because that'll never die. Everybody wants to, everybody wants less anxiety, wants to know what's going to happen, wants to have something to talk about at the cocktail party, or sound, intelligent on the date or whatever. So,
well, that's the thing, is that like I think about like all the things that I read. I'd say like get interested in markets too, though. Like the history of markets, there's so many like great stories. Like you could tell the whole like history of financial markets through like great stories, like
tons of controversy,
so much like fascinating stuff that's happening. It's kind of like, right now, like just think about the last year. Like, one thing that I'll never do is trust anybody or anything that has SB in a 3-digit acronym, right? Like, between SBF and SVB, but it's there's
always
so
a
much
villain
story here.
Yeah.
There's good guys, there's bad guys, there's
something new every day. They have to check in with you. If you have an ongoing story, an ongoing macro story, they always want to check in with you and see what, the news said something. What does so-and-so think?
Yeah. And I think that's a big reason why, like, some of the MarketWise franchises are so usually on top of it, they tend to be the first groups to come out with like the thematics that work in the promos a lot of times, because I feel like they, like Brian Hunt is someone that I bring up a lot. He had this great article and great conversations before about having like a front end idea needs to be around a trend that's going to last 3 to 5 years, because if the promo works, you need it to be able to, you want it to roll out. But if you have a promo that all of a sudden you can put a bunch of money behind and the trend's over in 6 months, you're done. Like you wasted that effort. And so like having these like longer term like trends that you're going to be working on, because then you can always update the story. Like things have changed, it's evolved, but the story's continued. And that's a really great front end idea. It's also a great way to look at your franchise in terms of the storylines and the copy that you're talking. But that's again a bigger discussion. But
yeah, I'm interested in using other things instead of just the traditional front end package, which we'll always put those out. Just other customer acquisition methods, other exposure methods, like a podcast or like a docuseries or like YouTube and and things like that.
I mean, like podcast sales letters are things now where you have basically like instead of a VSL, you have kind of a podcast set up. I've seen that in other markets. I've seen the docuseries approach is really interesting, especially from an acquisition, from a lead gen standpoint, getting people in and then getting their attention and converting them. Like all these, like we always know, like the format changes, the format things that work have always been mimicking whatever content is popular. Like going back to magalogs and bookalogs to infomercials, like, and so like every format that is like popular as at least as a lead gen, it's going to be really hard to turn a YouTube short into a sales letter, right? Like that's not gonna work so well. But like from VSLs to webinars to everything, it's always like the format of the content that's being consumed. You're basically trying to use the most popular format to kind of get your message across before somebody shuts it down, because they say, hey, that's an ad, I'm not going to even pay attention to the message yet, right? I mean, that's essentially what a format breakthrough is. It gets under the radar where the promotion feels like content, right?
Yeah.
And so I do think that all those different things work and are ripe for experimentation.
Yeah, I think it also comes down to the difference between old school. I should just say legacy versus next gen. The audience is a little bit different. I think you go a little bit more mainstream when you move away from legacy. If you have those front end promos where you got to keep watching it, and you don't realize it's a sales thing until 20 minutes in, or a half hour, or 40 minutes in, God willing. That's traditional finpub. Podcasts, things like that, docuseries. I think you get the customer kind of rooting for the company. One of the big things that we're trying to do is to really include the customer in the story of the company. So it has sort of like the Apple effect. Start with why. What's your why? We have a reason that we're doing this. We hate the way that the world is set up. We feel like the powers that be don't really want you to be super successful. They want to keep you going from paycheck to paycheck, and things like that. It kind of sucks. So they don't teach investing in school. They should teach it every single day, every single year until you're out of school. They don't teach that in school, among other things that are super important in life. So anyway, we want to get people behind us. It's not just customers. We want to create kind of like a little bit of culture or something like that. Culture, not cult. Maybe cult. But we want to have a strong following because they want us to succeed in what we want to do. We want people we want to get our customers to be as angry as we are about the way that life is right now. Yeah. So I think that's a younger customer. That's not the front end. It's just a different style. It's podcasts. It's a lot of free stuff, a lot of a slow build on the relationships. But a deeper relationship that lasts much longer. So it is an investment in time to build that up. So of course we're not going to shut one off and then move in the other direction. We have to keep doing the one thing while we gradually. That's why it's like a 3 or 5 year pivot. Yeah. So I don't know. I don't know. I watched your show with Connor, and you guys were talking about social media and the slow build of YouTube channels and things like that, which yeah, I agree with. It's hard, especially when the economy is kind of pushing you back on your heels to try new things. The first thing you do is you cut all the nice to haves and the things that you're trying and stop being progressive and just go for what you know.
Mhm.
But yeah, as soon as the economy becomes a little bit stronger, I think you're going to see a whole new industry
Yeah, no, I agree. I think,
emerge from the wreckage, you know?
yeah, I think there's still, a lot of things that we're doing right now will still work, and I think we'll see a lot of new players coming up. I think we'll see, yeah, just a lot of experimentation with marketing model and product model, and that kind of like revitalizes things. I think if we don't, if we don't start trying different things and new things in different models, then everything just kind of stagnates. And in digital marketing businesses, like if you're not changing, something's moving past you.
It's a weird, uneasy feeling because the industry's changing. You see the moving parts. You're always trying to figure out what the moving parts are. We know that we're not an industry that's meeting the subscriber exactly where they need to be met. I don't think that that's existed up until now. I think now we can start to really actually do that. It's a reality. But we've kind of been, mastering this piece, we sell that. We master this piece, we sell that. A lot of it is guided by what's hot at the time. So teach them about crypto or help them trade crypto, then that's not hot anymore. Nobody even talks about it or sells any of those products anymore. But yeah, I mean, it's kind of a little bit nerve wracking with everything. Kind of, it feels like it's floating around in a way. But I do feel like society is becoming more confident in data and things like that. They're more willing to use bots and algorithmic trading and things like that. I think people are demanding more authenticity and they're getting it. So it's a trajectory, it's momentum where the whole industry is forced to be more and more authentic, which only does good things, right? It brings real people, real strategies, it forces it.
Right.
And also, it might add pressure to people who don't know how to deliver that kind of service. But also think about how it opens the doors and attracts people into the industry who wouldn't have otherwise been in the industry because they're used to this sort of, the ways that they're not used to.
Yeah,
If you go back 20 years, it was kind of like infomercial stuff. Now it's becoming more and more authentic. People are getting in front of the camera and, not just reading script, but they're, podcasts and speaking off the top of their head. Real analysts are in the industry.
Yeah, we're seeing like there's new finpubs that are not from this traditional world. Like you look at what Genevieve at Grit Capital's doing. She grew off of Substack and very heavy short form social content, growing very aggressively. I'm not sure that their revenues are anywhere where
Who's
I
this?
think they would. Grit Capital. But hundreds, several. They're not like, I don't think they're a large publisher, but they're several hundred. Like I think 700,000. She has. I forget. I saw the audience numbers at one point. They were very big for what they were doing, and it's social first. It's short form, fast content with a back end newsletter. I'm not saying that it's a great newsletter business. The monetization, I'm sure, isn't quite where you would think it would be for the amount of front end like leads they have, but I bet you it's getting a lot better, and I think they're doing really well. And so we're seeing new entrants in the space that didn't come from the space, right? And
they're cleaning it up, and it's more welcoming to people who didn't want to get in before, and now they want to get in. It's sort of
and it's that people coming from, like, it's that idea of people coming from financial services world, realizing that media first in their career is important, and then realizing that they can have a side hustle all of a sudden that turns into like, hey, wait, this took off, I can make money with this is my career, I can invest in it now. And we're going to see a lot more of that. I think we're, more and more, I do see things like, oh, former Goldman Sachs whatever, in like some small influencers bio, and some of the larger ones too. I mean, like in the biz ops space. Like Cody Sanchez is killing it. She spent 7 years at Goldman, and she's doing a lot of biz op buying businesses kind of stuff.
Mhm.
And so I think we're going to see more and more and more of that coming out, and it's like one of those really positive revitalizing things in the industry, because that means more possible affiliate partners, more possible editors, because everybody builds one of those things, gets it to a certain point, and it's like, man, not everybody wants to have a big staff and run the business. They would love to have somebody else handle that. So I mean,
Right.
there's lots and lots of new opportunities that are coming up, and it's coming from outside of the traditional finpub industry, but they're forming essentially finpubs. And that's really exciting to me, because I think that one of the ways that we'll find multiple ways forward, right? It's not like there's one way forward. I think we're going to find a lot of different ways forward. We're going to find fintechs, we're going to find social, we're going to find all kinds of different things that are going to work, and that are working. But it's like getting that knowledge to kind of percolate across the industry, getting people to kind of like try some of these different models, but seeing the success of other people is much easier to kind of to make that mental leap. Like you were saying, it's difficult when things are changing. Like, my revenue isn't super high, how am I going to invest over here?
Right.
And so, but at the same time, like, there's a lot of cool things happening, a lot of cool new pubs coming up. And I think we're going to see a lot more, because what we need is that, we need a healthy, robust ecosystem, right? And this is one of my main things that I haven't talked about it in a while, but competition is not company to company in a digital environment in particular, right? It's not like true market insiders versus behind the markets, right? That is not what real competition is. What it is, competition is the ecosystem of digital publishing and media that kind of is working together versus a different ecosystem. And the easiest example of that is movie theaters versus streaming, right? There was a whole developed business ecosystem with movie theaters, and the threat, yes, the movie theater on the left side of Chicago is technically a competitor of a different movie theater on the right side of Chicago. But really the real threat to that industry was streaming, not more movie theaters.
Right.
And so it's the ecosystems that are developing that are serving customer demands in different ways. That is where competition is. And the reality is that in order for your model to be really attractive to people, you either need to scale into your own ecosystem that's so big that it can really like provide lots of value to the customer base, or you need to be part of another ecosystem that is as a whole servicing customers in a way that keeps them coming in and revitalizes the prospect universe. That is a big set of conversations to have, and I probably shouldn't go too far down that road right now. But
I Googled the origin of competition, and it's to meet, to come together. So as as opposed to competing with each other. I think a lot of the players that want to move into this next world where you have the different audiences kind of colliding, you have the different industries colliding, and we're going a little bit more mainstream and a little bit more reasonable, a little deeper relationship. I think you'll see a lot of the competitors kind of join forces because of a couple things, like the technology, for example. This is one potential play, not anytime soon, but one potential play for me would be, I'm building the technology, or the technology is pretty much built to be able to do things that a lot of finpubs can't do. But I know a lot of finpubs either want to do or are going to want to do. So that's a reason to partner up, with some really smart people, that's in this industry. You've got real players in the industry, real analysts, real money managers, not everybody, but you've got real people in the industry that want to deliver strong products. And it's hard to do it. I mean, if you're building a financial publishing, there's so many different things to think about all the time. It's like, to also then consider spending years building the technology you need to build to layer your own company on top of something. It's better to partner up with somebody or merge with somebody for the tech they have. So I think that will cause companies to form through mergers and acquisitions and become bigger and kind of stronger, and use the technology that's available nowadays and that will be available in the coming years to deliver an experience that really is beneficial. It's not just where they consider their play money and they kind of laugh it off. Now if you ask individual investors, anybody, whether they're investors or not, especially not individual investors, but even self-directed investors, you ask, if they're good at it, and they kind of chuckle, laugh it off, and then, they talk about their play money. And I think that's kind of messed up. I don't think everybody should just imagine if you just asked if anybody has a general understanding about their health and they just laugh it off. And, in 1980s, that was normal. And now it's kind of like, you're kind of a weirdo if you don't understand about kale or something. But I just think that I do think that the world's going to evolve in that way, the same way it did with health, the same way it did with computers. Mm-hmm. People are going to feel more confident about managing their own money, like the real money, not just the play money that they dick around with. So I keep coming back to that theme,
Yeah.
Like, I think the world's ready for it, and I think we have the tech for it, and that just hasn't been the case until now.
Right.
So, I mean, and so the cycles happen, the bull markets come in and get washed out, and then something new emerges from that. So it's kind of the way I see it happening.
I see it that way too. I think that if you look at like the last big washout in 2008, the industry that emerged from that grew way bigger than it was prior to 2008. Like, it got much bigger. It changed fundamentally. And the cycle previous to that was the .com crash. And that was the transition from a primarily direct mail model to the e-letter model, right? It was a big change that happened there. It didn't mean that direct mail completely disappeared, but it's the meta environment changes in these big business cycle changes. And I think that's what's about to start happening again, is we're gonna have a meta cycle or a meta environment change to how we think of publishing and what we think is in there. And I think that it's one of the most exciting, but also, like, I don't want to say treacherous, but I think about how, so like, go back to, and I know we're going really long on this one, but one final thought, I think, is that when you go back to looking at the transition that happened from direct mail to e-letter, right? Mm-hmm. So prior to that, I wouldn't say that, I mean, Agora wasn't the biggest publisher in the 90s in the direct mail, right? That was Phillips Publishing.
Phillips, yeah.
Right. Tom Phillips, like, sold off most of the business. He had 3 different segments, sold them off. Investor Place was one of those segments.
Yeah, that's where Tobin Smith came from. He basically founded.
Right. The two, but like, Investor Place basically declined for a long time before MarketWise acquired them and built them up, because they and the people, the 2 companies that really benefited well from that period were Motley Fool and Agora. The Motley Fool raised $100 million, right, in venture money. They ended up giving it back by 2008, and it was this whole thing. But they had raised about $100 million in venture capital to navigate and make the big transition over. Agora's model, which I think is, and I'm very conscientious of the halo effect and thinking that just because someone was successful, that everything they did worked. But I do think that this was actually one of the things that they did intentionally or unintentionally really well, that allowed them as an ecosystem to kind of emerge and dominate through that transition, was that they had, in the 90s, from a regulatory risk standpoint, split the businesses into different business operating businesses. And so now they had an ecosystem of businesses, and they were very entrepreneurial at that stage. They were having new people, like, hey, somebody had an idea about a franchise and a marketing model that they could figure this stuff out. Mm-hmm. And so, like, I remember, I think it was David Cross from the Oxford Club back in like 2005, talking about how they basically had a small group of guys who built up the Oxford Club in the beginning. I think it was the Oxford Club. I could be wrong. My memory is not the best all the time, but largely off of pay-per-click. But there are other groups who weren't doing that. And then what Agora's like kind of multi-division model allowed them to do was they had an ecosystem of people who they were funding to try and figure it out. And one group would figure it out, another group maybe wouldn't, but then they would get basically the knowledge of the group that did figure it out, much to that group's chagrin. And they would then switch over to that model and be able to grow. And so that kind of fluidity of like that having a multi-division approach allows you, or partnership approach, where it's like, hey, we have this central thing, or whether it's a bank, which is a super helpful an operational framework that you can kind of experiment off of to figure this moment in time out, and then we take those learnings and apply it to the rest of the business. Like that is a very, very not just entrepreneurial, but it's a very direct response kind of centric approach to figuring this stuff out. Like no one team is necessarily going to figure everything out. So if you have 3 or 4 or 5 teams that you can fund and can figure it out, then you're going to be able to like navigate these transitions. If if it's just one team, then you either need to be really on top of what everyone else is doing to be able to adapt what's working really fast, or you're at risk of putting your whole team behind a model that maybe isn't going to work, or it's not going to work in time for you. You know, like it's a complex thing, but I think that ecosystem approach of partnering with people, having something that can work with another group, allowing people a little bit of freedom to experiment with, like, hey, you have a couple of guys who are really good, who are really like convinced that this thing here is how it's going to go. This is what's going to work. And if you can let them try it, maybe they fail, but maybe they get you a new model. You know, I think that's a really, for me, it's one of those really important frames of how to think about these kind of media transitions or navigating them.
What am I going to do? I'm just one company.
Well, everyone's just one, but that's the thing. That's why you have to be able to work together, be able to share information. If you're talking about the tech piece, you have the tech piece that you're talking about, like adding to a website in a data model to a website. Somebody could partner with you who doesn't have that piece, and they are experimenting with other things. And that's where like the ecosystem starts to get healthier, is the opportunities to work together get very, very interesting and more important right now.
I think, you know, the industry is set up in a way where nothing's a secret, right? There's no success that's a secret in the industry. So pretty much if you're plugged in and or you're not, that's, you know, pretty fascinating part of our industry. It's like if you're not going to your annual event or, you know, any of the other ones, you're just not plugged in at all. I can't imagine somebody trying to grow in this industry without being plugged into everybody, right?
Yeah.
So, I mean, it used to be, Agora was the second largest publisher. Phillips used to be the biggest. Phillips, when I got in the industry, Phillips was doing 200 million. Agora was doing about 100 million in total, I think. The fact that they had so many different companies as opposed to, you know, Phillips, I think had fewer, is definitely, I think one of the biggest contributors to their growth is just that they had all that data to share in the Zambezi report. And then everybody, you know, started just trading notes pretty much. And I think a few people got it right. We were talking about Jeff Walker on the last episode with Connor. Everybody who adapted to that very early, very quickly, did really well. We did really well with that. But yeah, I mean, having a bunch of different companies, I guess, I mean, that was a big part of their growth, having all that data. But I mean, now everybody has it, right? I mean, everybody pretty much knows what everybody else is doing, especially now that you have media buyers that are, you know, so many brokers out there that are just sharing. It's impossible to hide it. But I mean, back to the just one last thing I wanted to say about that, the whole FTC conversation and everything, with respect to our industry and everything. I mean, there's whether or not they agreed with the marketing, that was one thing, but you've got you know, when everybody's listening to Merrill Lynch or Goldman Sachs, or everybody's listening to, you know, and you found out in the 90s when Elliot Spitzer charged everybody with fraud, top 10 biggest brokerage and banks, you know, you found that they were telling their institutional investors, sell this stock, it's a piece of crap, and then putting out a buy recommendation that day. And that's just the famous one. Like, I saw that all the time on Wall Street. You're not in good hands just because it's a big company. And you all have kind of a unified message on what everybody at the firm seems to all agree is going to go higher. Like, you want alternative information. And in the 2007 top 08 bear market, you know, a lot of companies in financial publishing helped people navigate through those markets get out of the way when this shit was hitting the fan, get into the right industry groups. You know, I can name probably 5 or 7 right off the top of the head of people that we're talking about in 2006 into 2007, guiding everybody, you know, through it. And, you know, I know I can name probably 5 off the top of my head of people who said, get out of the way right before COVID happened. This is an industry that you want, you know, it's an industry you want to flourish. You know, so whatever, you know, the marketing, you know, that's pretty much been cleaned up as far as I could tell. I don't really think that there's anybody else who's still out there, you know, writing aggressively. So I just think that this is an industry, no matter what happens, how it evolves, I think it's going to come out of the tough economy, emerge much stronger and bigger than anybody's ever seen or even imagined. It's always been the way it's been. I've been in the industry for like 20 years, and you never would have believed. I mean, Agora got up to $1.5 billion, you know, or whatever they got up to. All the things that we've seen with market wise, everything that's happened with Porter and everything. It's like an acid trip. It's like a crazy movie, you know, watching this industry. But you know, one thing's for sure, it's not an industry of dummies. There's a lot of very smart people, talented people, and you know what we're doing. You want that out there, you know. You just want to help us figure out the best way to, you know, to create it. It's the best way to create the best experience for people. I remember in 2012 we had a live seminar, and we sold it in the summer of 2011, right after my company was acquired by Agora. We sold a course and we sold a live seminar, and like 150 people came down to Delray, and it was the opening remarks, and Dylan's at the podium, Dylan Jovine. And like one of the first questions, somebody raises their hand and says, well, you know, you guys are from Wall Street, you know, it was me, Teeka, Wayne Mulligan, people like that. You guys are really from Wall Street, Costas Bocelli. It's like, you're the real deal. Why do you guys send us the same kind of marketing that everybody else in this industry sends us? You guys are above that. And then I felt really awkward for like the longest 5 seconds of my life. And then Dylan, like, he pulled a Dylan and he like paused and he thought about it before just opening his mouth and thought for a minute. And he was just like, that's what you guys respond to. So the day you guys stop responding to that, it's the day I'll gladly will stop writing, you know, so aggressively to you. But you wouldn't be here if it weren't for that. We wouldn't be teaching you if it weren't for that. You know, that's what you guys respond to. So we're kind of in a, you know, in a weird position as marketers or copywriters, because it's like, that's what it takes to get people in the door, to show them how to be responsible with their money and to think about markets realistically. That's what we've done, you know. So, you know, we do in a sense want to partner with the, you know, the powers that be and help us navigate this the right way. You know, the one thing on this call that stands out for me is when you said that they used to go to different events and try to teach businesses what they want to see. I think that'd be great if they could do that a little bit more nowadays. So I haven't seen that.
That would be great.
Yeah.
Cool. All right. Well, this has been a really long conversation and I loved it. And so I appreciate it, Chris.
Yeah, likewise.
I always love talking to you.
You too. Again, I love what you're doing for the industry. And again, it comes down to the customer at the end of the day. It comes down to the subscriber. You're influencing what, like 20, 30 businesses, like big businesses, big for our industry. You're lifting it up, you're raising the bar, you know, ultimately that trickles down to the subscriber. So people, you're going to be like one of those unsung heroes at the end of the day.
I appreciate that. Thanks.
Story. Yeah.
Awesome. Well, thanks again. And I'm sure we'll have another conversation sometime in the future. So.
All right, John. Glad we finally got to catch up.
Yeah.
All right. Take care. Bye.